Hello, everyone. Welcome to today's webinar with me, Fawad Razaqzada, market analyst in London, and my colleague Victor. Hello, Victor.
Hello, Fawad. Uh, what a time to be alive.
Indeed. I don't know how much longer we've got in this world, given the situation in Ukraine and Russia and everything else.
So let's make this webinar count.
Indeed, let's do that. Well, the markets have been all over the place, haven't they, in the last several weeks, as investors have responded to the situation in Ukraine and the sanctions that have been imposed on Russia and all of this tit for tat between Russia and the West. So volatility is here to stay, and the new month has started on the back foot after the markets staged a impressive rally on Monday to fill all of those gaps that were created at the weekend when the situation deteriorated further between Russia and the West. Let's first of all deal with this mandatory disclaimer, and then we'll talk about the markets.
Yeah. So these webinars are for general information only and are not intended to provide trading or investment advice or personal recommendations. Any information relating to past performance of an investment does not necessarily guarantee future performance. Think markets shall not be responsible for any loss that you incur, either directly or indirectly, arising from any investment based on any information in this webinar. Please remember that spread betting and trading CFDs carry significant risks and may not be suitable for all investors.
Indeed. So if you ever wondered how headline-driven markets look like, well, this is it, isn't it? After staging a sharp recovery of the lows yesterday, we're seeing renewed weakness for the major indices. So, for example, if you look at this is the German DAX, the S&P 500 here, massive recovery from the lows yesterday, but there's been no further upside as the indices have turned lower once again. The NASDAQ as well, if I can find it. Yeah, it's here. NASDAQ has gone back into that resistance zone, struggling to make headway after its impressive recovery yesterday. So it looks like the new month has started on the back foot again. There was a sense of optimism after Russia and Ukraine started talks that could potentially lead to a ceasefire, but that optimism has evidently faded quickly now. It looks like the latest falls come on the back of remarks from Russia's defense minister, who earlier said that Russia will continue its operation in Ukraine until it achieves its goals. So investors maybe they're fearing that Russia has gone too far in this to kind of blink first now. So we're seeing Russian assets lose value sharply. We're seeing crude oil remaining bid, stock markets struggling. Gold and silver going up as you would expect on haven flows. So it's all happening. Where should we start, Victor?
So yeah, let's start with gold. I would say that your instincts are correct in opening this chart. We have seen this hammer candle form on the weekly chart last week.
Yeah,
I feel like this is the bear trap of all bear traps. What do you think?
Yeah, I agree. When you get bearish looking candles and you don't see an immediate follow through, you know that it's a trap, and so far it's proving to be that way, not only because of obviously everything that's happening in Russia and Ukraine and everything else, but from a purely technical point of view. The inverted hammer that was printed last week comes on the back of a massive breakout from this long-term bull flag pattern. So gold spent more than a year in this consolidation, if you like, and then it finally broke out. So given the length of time it had spent in this consolidation, any dips that we've seen in the short term have been bought. So if you look at the daily, for example, we saw this bearish candle several days ago. No downside follow through whatsoever as the dip was bought at support prior resistance. We broke out to a new range
Yeah.
and then we fell again. And then this time, once again, the buyers have stepped in right where they should have at support around 1877 to 1880 area, this area here, which was previously resistance. And they bought that dip, and the market is now going higher again. And we're testing the 2011 highs. Let me just show you that on the weekly time frame again. The 2011 high is here. This was the then record high, which broke in 2020 in response to all the liquidity, central bank liquidity that was provided in response to the pandemic. We didn't hold above that level, and then gold went into a very long, lengthy period of consolidation, but we are now breaking out again. So I reckon, Victor, that there's a good chance we will be heading above the 2000 level once again on gold.
Yeah, I reckon that we could be there before the end of the week. In fact, the way things are going, the the hopes for de-escalation are with the Ukrainian government, which has to basically yield to Russian demands.
Yeah.
And yeah, I'm not so sure that they want to yield to these demands. So yeah, that's every day this war lasts is basically another increase in the risk of this situation getting out of control. Yields are falling.
Interesting, that isn't
stocks stocks are, yeah, well, it's really not that it's really a no-brainer, because the more tense the situation is, the more unlikely it is for central banks to undertake to engage in any aggressive tightening of financial conditions.
Sure.
And this is something that is very very positive for gold.
Yeah.
And for now it has not impacted the dollar that much, because obviously we are seeing that aside from the US 10-year yield, European yields are also heading lower. But yeah, this is great for gold and for other precious metals and for commodities in general. We're seeing the oil market once again charging higher. We also had these daily candles last week that were quite negative, and then we're seeing this candle today. And what can you do? Like, it seems like oil is going to continue to charge higher, because the from what we're seeing, the European continent is standing firm behind Ukraine. They're providing weapons, they're providing humanitarian assistance. And that is not going to calm Russia down. There was a rhetoric from the US yesterday. President Biden said something very important, and I feel like everybody should listen to him. We must not isolate Russia out, because it's as simple as that. The only reason Russia is not charging against anyone else is because we're trading, and they're selling their resources to us The moment we decide that we want to be enemies, prices for resources are going to skyrocket. They are already pretty high.
Absolutely.
And Russia will have nothing to lose when it comes to using more serious weaponry.
You mean weapons of mass destruction?
Well,
Let's
first
hope it
of all,
doesn't
they
get.
have tactical nuclear warheads,
Mm,
which some analysts are saying that if they don't manage to overwhelm Ukraine during the next week or so,
yeah.
they might use tactical nuclear weapons, which don't cause, they're not like strategic nuclear weapons. They don't cause a massive radiation wave or
Okay.
whatever. They're just focused on and can be used with friendly forces nearby.
Right.
So yeah, it's really like what's going on is really scary for the world right now. We haven't
Yeah.
been this close to the Third World War. We have never been this close to the Third World War.
Indeed. I mean, yeah. So it's all about Russia, Ukraine, and the West's response at the moment. And we talked about crude oil. We talked about gold. Going back to gold. Actually, we talked about bond yields falling. Obviously, there's the what you mentioned, Victor, about central banks not they would be less willing to tighten their belts aggressively because of the situation. But also there's some haven flows as well into bonds, into government bonds, which is causing yields to go down. So it's not just because of investors reducing their bets about an aggressive rate hiking cycle. It's also because of haven flows into government bonds in the US, Germany, and the UK in particular. I
Yeah,
just want to mention that just in case. But yeah, the whole situation is kind of it's overshadowing everything else. I mean, this is meant to be a very data heavy week, isn't it? We have so many things coming up. We had the RBA last night, overnight, I should say. They decided to keep interest rates unchanged, as you'd expect from the RBA, although other central banks have started to tighten their belts. We have ISM manufacturing PMI coming up later on today from the US. Wednesday is going to be, let me just bring up the calendar while we talk over this, because there are a few things of note that we should talk about. Just give me 1 second. So yeah, ISM is coming up later. Aussie GDP is going to be very important. Well, you'd expect it to be very important in normal circumstances. Usually causes the Australian dollar to move sharply. Eurozone CPI, again, something really important. Inflation in the Eurozone hit a record 5.1% in the previous month. And this time it's expected to have risen even further to 5.6%. And given the energy crisis in the Eurozone with oil prices going up and gas and electricity prices as well because of the situation in Ukraine, you would expect inflation to go up considerably more from here, wouldn't you, Victor? And that's going to cause a major headache for the European Central Bank, because on the one hand, you have a soaring inflation, while on the other hand, you have weak economic growth. Already it was weak because of Omicron, but now just as major economies have reopened their borders, we have this Ukraine situation, which is undoubtedly going to impact the economic growth, not just in Russia, but around the world. So the ECB's hands are kind of tied in the sense that economic growth is not going to be strong, but at the same time, inflation is soaring. So you have stagflation, in other words, happening in the Eurozone. And this is why investors have pushed back their rate hike expectations from the European Central Bank. Prior to this whole Ukraine situation, the market was expecting the first rate increase to be in December of this year. Now they've pushed it back to early parts of 2023. So that's the situation with the European Central Bank. Sorry, were you saying something, Victor? I cut you off.
Yeah, I was saying that I wanted to say that the ECB is probably not going to be the only central bank that is going to tone down its rhetoric on rate hikes. I'm not even so sure what the Fed is going to do at the next meeting in March. Perhaps they're going to hike, yes, because everybody is expecting them to do it. But
everyone and their dogs.
As far as a commitment for a more aggressive rate tightening or something like that, I really doubt it, because it's pretty much at this point in time, with this situation taking over the headlines for everyone in the world, pretty much, consumer confidence numbers are going to get hammered. Business confidence numbers are going to get hammered. So yeah, it's definitely not the time for announcing any aggressive monetary policy measures. And after all, the main driver for inflation are energy prices, and there's not really that much that the Fed can do for energy prices. It's all about political will to like. I was reading a tweet by the longest serving no, the longest time champion in chess, Garry Kasparov, who is a dissident from the Putin regime, basically. He ran away from Russia, or was pushed away, rather. Was pushed out in 2013. So he was saying that the US and Canada should immediately restart the Keystone XL pipeline project and basically flood the world oil markets with as much oil as they can pump as soon as possible. Because this is the main source of income for Russia. The higher the oil price, the better it is for Russia. And current oil prices are absolutely playing into the hands of the Russian government. So yeah, that's
very interesting. Very interesting indeed. Yeah, so while you were talking about that, I just brought up this really useful FedWatch tool that the CME Group produces. It gets updated all the time based on the forward prices. And you spoke about how aggressive the Fed is going to be. There was some speculation that the Fed would be hiking interest rates by 50 basis points at their March meeting. At their March 16 meeting. Well, that's completely out of the window now, isn't it? I mean,
that's gone.
The probability of that happening now is literally less than 5%. A week ago, it was still around 50-50, and a month or so ago, it was even higher. But the market is no longer so sure about an aggressive rate hike. So it looks like it's going to be a 50 basis point hike. Sorry, a 25 basis point hike.
Yeah, I'm curious. Where are we towards the end of the year?
So maybe in 14th of December.
Yeah.
Let's have a look. So This is the midpoint. The 125 to 1.5% rate increase is the midpoint.
So that's basically a hike at every meeting, isn't it?
It sounds like that, doesn't it? Yeah.
Yeah. Well, it's still pretty aggressive. So
Yeah.
there's still, I would say that the Fed can still disappoint.
They
I
can do.
mean,
Yeah. They have a
they
tendency to do that.
disappoint the hawks that are
Yeah.
expecting an aggressive
Yeah.
rate hiking path.
Yeah. Yeah, the longer end hasn't changed much. It's just a short term.
Yeah.
In the March meeting, previously they were expecting. The market wasn't sure whether it's going to be a 50 basis point increase or 25 basis.
Yeah.
Well, it looks like it's going to be 25%, and I
Now
think
it's
kind of
pretty
makes sense
sure.
because they don't expect the situation with Ukraine and Russia to last very long. I think sooner or later something's got to give, right? Either resistance by Ukraine is going to give way, or Russia might, after all, blink first because of the tough economic sanctions that the Western governments have imposed on the on Moscow. So that
Yeah.
is something that hopefully the situation is going to calm down very soon. Let's hope so for everyone involved that that's indeed the case. Obviously, the longer this thing goes on, the everyone's going to be worse off, except oil companies. What else are we looking at? So let's go back to the indices, shall we? Because we
Sure.
touched on the indices. The DAX is really struggling now, isn't it? I mean, it broke down
Yeah.
decisively in this support area, and the last time we spoke, the market was coming back to retest this level, and it held and it sold off again. We rallied again, sold it. This is the characteristics of a bear market. Every time you
Yeah.
get
Yeah.
bullish looking price action,
yeah.
it gets sold into, for example, this hammer. And speaking of
Yeah.
which, just before we move on from Germany, German economy is heavily linked with Russia. There's so much exposure of German banks or European banks, I should say, to Russian companies. And if you look at some Russian stocks, they are, well, what can you say? This is a famous one.
Russian stocks actually are closed
Yeah,
this week.
yeah.
This is not a realistic view of the market.
Didn't they open today? I thought they opened today.
No,
This is
they
closed.
continued
Yeah,
the
this is closed. Yeah,
moratorium.
yeah.
So the market is still closed. There is a rumor that
Yeah, it's still closed. Okay.
about 1 trillion rubles, which I'm not sure how much that is. Yeah, divided by 100 roughly.
Yeah.
From the sovereign wealth fund is going to be committed to buying Russian shares when the market opens.
Right.
So
Okay.
basically, the Russian government is taking matters into its own hands and
Yeah.
committing certain funds to provide liquidity in the stock
Right.
market.
So yeah, I was just mentioning that there's lots of exposure to European stocks from German in Russia. Basically, European companies have major exposure in Russia, is what I'm trying to say, and that it's impacting European stocks. The situation, so that's why we're seeing the German DAX in particular doing really poorly at the moment. Moving on to the US, and I was just going to share the chart of the S&P 500 and how bullish looking candles are continuing to fail traders, for example, on all time frames. I mean, this is the weekly time frame, right? Several weeks ago, we had this hammer candle printed on the weekly chart. Usually, when you see something like that, you would think the market has bottomed, right? We saw a moderate further upside after the formation of that candle, but then there was the bears came back in at resistance, this area here, the backside of the trend line, and they sold the market. Last week we saw a similar looking hammer candle, and there's been no follow through on the upside. I know the week has only started a day or so ago, but so far we are struggling to hold around the closing levels of the previous week. So if I mark the previous week's high, and you can see that on the this is the daily chart, testing resistance here, major resistance, right? This area was, if you think about this candle, right? This is where the last buying started, that tried to break back above the 200-day moving average, which failed spectacularly. So if you mark that area, think of it as a supply zone, yeah, or a former support area that failed to hold on the when the sellers came back in. So now we are retesting that zone from underneath, and so far it's holding as you would expect. So in a bear market, you'll get big rallies. Yeah. So just because we've come back really impressively off the lows, it does not mean that the market has bottomed out. Get used to this kind of price action in a bear market. And for as long as we remain below the 200-day moving average, I reckon that it would make sense to actively look for bearish trades rather than bullish trades, because the underlying trend is bearish. Indeed, the S&P on the daily is stuck in this bear channel, so it's making lower lows and lower highs. And until and unless that changes, the bulls are not out of the woods. And similar price action is observed on all major indices in the US, as well as the NASDAQ 100, which is interestingly testing this key resistance area, which was the October low to this area here. You can see there's lots of price action around this zone. I reckon it's there's a risk that we may see some significant drop here. The FTSE was outperforming other indices as of late. Still is doing relatively better, but it's struggling now. It's really struggling with everything going on in Russia and Ukraine.
Yeah.
But out of all the major indices, I think the FTSE is the strongest because it's got lots of miners, and mining, commodity prices have been going up. Also, energy companies. It's got some banks which have exposure to Russia, obviously. BP had a 20% stake in a Russian, major Russian oil company, which it decided to sell. So that weighed on BP shares. But the FTSE itself, for as long as it remains above the 200-day on the closing basis, I think that would keep the bulls happy.
Yeah, the FTSE itself actually is pretty heavy on industrial commodities, right?
Yeah.
So having in mind that industrial commodities are very likely to skyrocket in the near weeks and months, years, probably the FTSE is the last market that you want to go short on.
Yeah.
Not the case with the NASDAQ, I would argue.
No. Yeah, indeed. Let's move on and look at some cryptos. Maybe interesting week for cryptos, hasn't it? Bitcoin has attempted a recovery.
Yeah, I have a very good explanation.
Go on then, enlighten
sanctions. The way to go around sanctions. Guess which it is. Guess which one it is. The favorite way to get around sanctions has been to buy cryptocurrencies and funnel your money out of the country. And this is precisely what I feel like the Russian billionaire class is doing right now.
Right.
And I do expect there will be a reaction on part of international authorities. So I do expect very sharp turn in the rhetoric against crypto, or pro crypto and against crypto, whatever. Both rhetorics are going to change sharply as Western nations realize that any effort that they impose with sanctions can be circumvented by using cryptocurrencies. This is also what has been the main use of cryptocurrencies since they were created: money laundering and financing of dodgy operations.
It's
So
difficult to prove. Yeah, obviously there's
as
some.
well as speculation, but you
Yeah,
cannot put
you can't deny.
speculation as
You
a
can't deny. Yeah,
real as a real use. That's not
yeah. That
real.
was not the main purpose of it. Yeah.
Yeah.
But obviously
So this
the West.
can go on for a while, and
Yeah.
the pump. First of all, many people have been saying over the past years that Russian billionaires own a lot of crypto.
Hmm.
If they are a significant portion of the whales in the crypto market,
Hmm.
they are the ones that are driving the price.
Yeah.
So I'm expecting a pump and dump in
Right. Right.
cryptos over the coming weeks as Russian assets are getting out of the country
But
into other
what about
jurisdictions.
Western billionaires that are involved in the cryptocurrencies for the same reasons you mentioned? Russians, surely they don't want to. Uh,
To facilitate the pump and dump scheme of the Russian
yeah.
whales,
Yeah.
yeah, well, if they don't, they should leave right now. They should sell their positions right now
Right now. Yeah.
before any regulation makes them to do so.
Right. Okay. Fair dues. So from a purely technical point of view, I don't think Bitcoin is out of the woods. It has had similar price action in the past
Yeah.
when it tried to break out. So after things changed here, right here, this was the reversal, right? Look how many times we've seen really strong bullish recoveries, which have ultimately failed. Another one very similar to what's happening here was in this period here, which was met with a lot of resistance. We're seeing yet another attempt over here. Whether or not this one is going to be a bit more successful remains to be seen. But the fact that Bitcoin has is doing this at support around 40,000 to 35,000, this area here.
Yeah.
The fact that it's doing it here, the likelihood of a more sustained recovery is higher than would have been the case at higher levels, because obviously a lot of people are still involved in crypto. They still believe in the future of cryptocurrencies and think that Bitcoin could be headed higher. So from a tactical point of view, I think it needs to break above the shaded red region, which was previously resistance. I think if we get a clean breakout above that, could happen today. You never know. The day has just started. That would, in my view, would be a bullish development. What happens, what happens after that in the days to come? Who knows? In terms of in terms of sanctions or regulations or whatnot that could negatively impact crypto prices. But a break above the shaded red region for me would mark a major turning point. And if that happens, the path of least resistance would no longer be to the downside anymore in the short to medium terms. So watch out for that breakout. But yeah, equally, it could prove to be a fake out, as Victor mentioned. In other words, this is cautiously an optimistic, technical development that we're seeing right now. But even if we do get a breakout above the area I just mentioned, proceed with the extra care given all these headlines that are coming out of Russia, which could negatively impact crypto assets as well. I think we have run out of time, haven't we, Victor?
Yeah, yeah. I think that we've touched upon. Oh, did we talk about oil?
We didn't talk.
We mentioned that it was, yeah, but we didn't.
Yeah, we talked about Brent and WTI is at 99.
And WTI, yeah, it's looking very bullish.
Yeah,
it's looking as it's breaking out of above $100, and yeah, that's really it's really dire for the economic recovery across the Western world. It's going to hit consumer pockets very materially.
This is what I meant. Sorry to cut you off as well, there, Victor. By lack of follow through when you see bearish candles.
That's the same which you mentioned about gold.
On gold, yeah. So we saw this inverted hammer candle that looked really bearish, didn't it? But look what happened. We broke the low of that candle. Very moderate downside follow through. Price found support at 90. We didn't break the previous low, and once we went back above the low of that candle, you know the sellers are in trouble. And lo and behold, prices have recovered in the last 2 days. I know it's been fundamentally driven, if you like, because of Russia and whatnot, but technicals as well, you just can't ignore it. So from here, it looks very likely, in my view, that stops resting above 150. Yeah, the high of this candle was 150. The stops above this area candle from people who thought oil had topped out, those stops are going to be in trouble, and I think it's going to be a fast breakout now above 100. And some of the targets, well, the 127 extension of the downswing from this candle to the low comes in at 103. The 161.8 extension is at 106.90, so call that 107.
107. Yeah, and 110.
Yeah, we could even get to 110, but yeah, the immediate targets for me would be 103. The psychologically important 105 level, and then 107. So those are the next key levels to watch out for. In the likely event, we'll get a breakout above the 150 area, which we are getting very close to right now.
Which is looming.
It's looming indeed. So there you have it, guys. Yeah, thank you so much for joining us in this webinar. You've been very quiet, attendees today. We can't see any questions from you guys. For those of you who are watching a recording of this, please make sure to join us live next time. Next Tuesday, we have the same webinar at 11:30 London time. And before I move on, we have a special webinar coming up. Well, two special webinars, but the first one is more immediate. It's on Friday. So if you go to Think Markets, you'll see which one I'm talking about. Go to market analysis. If you go to news section, we provide this week ahead report, and because this week we have lots of events coming up, including the jobs report on Friday. Yeah, we tend to have a preview webinar for the non-farm payrolls report, which happens on Friday at 11:30 London time. So if you click on that link, it will take you to the registration page. So you simply fill in your details and then register. And that way you can join us live on Friday, 11:30. So I look forward to speaking to you guys then. Take care and have a wonderful week ahead.
Take care. Thank you, Fawad. And
thank you.
Stay sane in these markets.
Absolutely. Absolutely. Bye now.
Cheers.